Hey guys, welcome back to Invested. Taking a question, which hard costs and soft costs will banks typically fund? Trying to fill out sources and use statement. The land is already owned and will be injected as equity, and the bank fees and interest pay expenses will be funded out of equity. How do I determine which percentage of hard costs will be funded by the bank's loan? Same for the soft costs. So, good question. Hard costs and soft costs is generally construction costs, right? Hard costs, to just define it, a lot of people may know it, is actual physical construction work, the concrete, the stucco, the thing that is materially you can touch, right? Soft costs, it's a little bit flexible. Your legal expenses could be soft costs, your engineering fees, your site surveys, those things that might still be required, but they're not the hard actual materials that's going to go into developing the asset. And also FF&Es, which is furniture, fixtures, and equipment, could be also considered as soft costs. But most banks are not going to fund you FF&Es. Let me take that back. Majority of the banks won't do that because that's unique to your business. So unless it's a business loan like an SBA, they're really not going to fund that. So I'm going to take an assumption that this is a traditional bank. So there's two things. There's two terminology you should get familiar with. Something called LTV, which is loan to value, and LTC, C as in Charlie, loan to cost. So most of the time when you hear in the real estate world, when I'm buying something, oh, bank's going to give me 60% LTV. Then typically what that means is if you're buying $1 million property, essentially the bank's going to give you $600,000 as a loan. So now if it's going to be heavy value add or repositioning, you might buy the property at $1 million, but you need, let's say, additional $500,000 for your cost. So now your all-in total project cost is 1.5. And depending on the asset, if there's cash flow currently, or if what your strategic business plans are, or how much money or you have in the bank with that, right? That can also give some weight. They will size the deal based on loan to cost. So what that means, they'll typically help you with the cost of purchasing the asset plus participate in the construction cost, which is hard costs and soft costs. So generally, most banks are not going to bifurcate what the hard costs are and soft costs are. They kind of generally see as a total project cost, and does it make sense for me to fund you at 70% of LTC? And I can't say today's market is really challenging, but back, let's say, pre-pandemic, most lenders will lend you up to 72 to 75% of LTC, especially if it's multifamily or more durable assets such as industrial. Retail, office, they might bring down below 70, but it all depends on the region and the market as well too. So I don't think you have to get too granular with the soft costs. I think you should kind of break out hard costs, soft costs in a general format to kind of show the bank from sources and use that this is my acquisition cost and this is going to be my construction cost. And if they do ask for details, then you can kind of break it out a little bit further. Hopefully that answers your question. If you found this content helpful, please like, subscribe, and follow us. Thank you very much.